Hi, welcome to another episode of 2 Minutes on Tuesday. I'm Sam Miller.
I'm Erica Miller.
And this week's topic is going to be the 10 most common reasons that renters have decided that they weren't sure they could buy a house, but we've ended up helping them buy homes. But these were their 10 biggest obstacles of what prevented them from thinking they were in a position to buy a home. So without further ado, Erica, let's go with number one.
Yeah, so number one is the biggest obstacle renters tell us is that they don't have enough money for a down payment.
Yeah, and we've heard that over and over and over. We hear it every week, every month, every year. I've been hearing it for years. And this is the good news. We're so fortunate in Knox County because we have no money down and very low down payment loan programs. We've got a program called USDA that doesn't require a down payment. We've got VA for veterans that doesn't require a down payment. We even have FHA, which only requires 3.5% as a down payment. So the concern that a renter would have really is not warranted if they don't think they have enough cash. Chances are we can make the deal work because of the financing options that we've got available. So if that's holding you back, give us a call and we'll tell you what to do and how to do it and tell you what loan program best fits your needs.
Yep, and then number two is that they think that they have to keep running because they either have a bad credit score or slow payment history on their credit report.
Yeah, and so different loan programs have different credit score requirements. So like the conventional loan program, that one has a little higher credit requirement. But like if you're buying FHA or USDA, you don't have to have the exact same credit score. It can be a lower credit score. And actually, you don't have to have perfect credit to buy a house. And they really don't go back, like some people think they go back 5 or 10 years on your credit. They really don't. I think the only exception to that, they do look at, like if there was a bankruptcy, they do look at that as on a longer period of time, not 10 years or anything like that. It's much shorter. So, but in most cases, they're really looking at the last 2 years. The focus of your credit is on the last 2 years. And let's say your credit's not great. You still want to let us know if you're interested in buying a home because we can put you on a map, a roadmap showing you what you need to do to get your score up. So when the time rolls around and it's 6 months or a year from now when you're ready to buy, you've made those tweaks to your credit to put you in a position so that you can buy.
Yeah, and number three is that renters think that they have like a high debt, like say they've got a lot of student loans or credit card payments or a car payment that they have, they feel burdened by these payments or these debts.
Yeah, and I've seen that so many times where a buyer's like, I want to buy, but I don't think I can get a loan because I've got this big student loan. I got $30,000 still remaining on that, and I got a $500 or $600 car payment, and my credit card account is practically maxed out, and I just don't feel like the bank's going to qualify us. Now, let me tell you that sometimes that is the case, and sometimes you have too much debt. But don't freak out. That debt can usually get rolled away through either refinancing your debt, making that payment lower, merging multiple debts. If you've got a really expensive car and you're like, I really don't need that car anymore, I can get something more affordable. You can trade that car in, maybe go from a $600 payment down to something more in the $300 or $400 month payment. And really what it's about, it's not necessarily about how much money you owe. It's about the percentage of your income compared to the debt, known as debt to income ratio. And there's some ratios or some guidelines that you need to stay within. So, but we've not seen a lot of cases where someone has too much debt where we can't work with them to help them get a loan. Sometimes it takes a little structuring, but it is a possibility. And I would not say don't buy a house just because you've got excess debt right now.
Yeah, exactly. And number four is going to be that they are self-employed and that they've heard that it's difficult to get financing. Think like hairstylists, nail technicians, servers, waiters.
Yeah, those are great examples, and I run into that a lot. Specifically, if you're a barber or you're in the beauty salon business where a lot of your money that you earn is not through your hourly wage, or people that work in restaurants where they're servers, where a lot of their money comes through tips. It's not reported. It's certainly possible to still get a loan, still qualify for a loan. We have to do some additional verifications. You do have to have a certain amount of time on the job in order to qualify. You can't have just got a job as a server at a restaurant and maybe only have 3 months worth of income, you're not going to qualify on that. You're going to have a certain amount of time on the job, and your income needs to be fairly consistent. They also look at, has your income gone down? If your income 2 years ago was X amount and then this year it's X plus 50%, that's the way they like to see it, or it's the same. They don't want to see where 2 years ago you earned income here and now your income's clear down to here. That's usually not a good sign for self-employed. So, but if you got questions about that, feel free to reach out to us. We're happy to help you with that as well.
Number 5 is they think that they're going to relocate in the next year or two and don't want to make a purchase on a house.
Now, this is probably the most reasonable and logical reason why someone would not want to buy a house. And I would absolutely agree. This is probably, if you're only going to live here for a year and then you're going to move away for a job or you're getting married, you don't want to buy a house and then turn around a year from now resell it, because the selling expenses to sell the home plus the closing costs for you to buy the home, you probably don't get your money back even in an appreciating market. So you do need to plan to stay in the house, depending on what the market's doing. It could be anywhere from 3 years to 5 years or more, and you're usually pretty safe.
Number 6 is no one in their family has ever bought a house before, so they don't think it's possible for them.
I've had so much fun with this one. My mom and dad have never bought a home before is the thing that I hear, so I didn't think I could. And what's fun is you help a first-time buyer that's never bought a home before, and they're blown away because they thought it was out of their ability to do it. And I've had cases where the kids bought the house, they're in their early 20s, and they buy their first house, and then their parents call us and say, how the heck did you do that? Little Johnny, he bought a house. Can you help us buy a house now? Because they thought it was never possible for them to buy. So that's exciting for us. It's certainly exciting for the kids, and then see the kids' parents buy their first house. So if you guys have that going on, don't let that be a stumbling block. Because, you have to think, when you drive down the street and you see all these houses, somebody owns those homes.
Number 7 is that they think that buying a house is going to be much more expensive than what they're already paying in rent.
Yeah, and in so many cases, it's the exact opposite. Especially when the interest rates were extremely low, the monthly payment on the home with taxes, insurance, in a lot of cases, each month was actually cheaper than what the renter was paying in rent before. So in lots of cases, it's actually cheaper. Now, there are the exceptions where if you're living in a rental where the rent's $900 a month and you go out and buy a $400,000 house, the payment on a $400 is going to be a lot more. But if you're moving out of a rental and moving into something of similar size, it's probably going to be cheaper in most cases here in Knox County.
Yeah, and I think that's something a lot of people are just surprised by. Number 8 is that they don't have enough money put aside for loan closing costs.
Yeah, and the cool thing about that is a lot of the buyers that don't have money for closing costs, we have the ability to structure the purchase offer with the owner where, in addition to the purchase price, you're asking the seller to contribute towards your closing costs, which means it's money that you don't have to come up with as a buyer. So instead of you coming up with a down payment if you need one and closing costs, maybe you only need the small down payment, and the seller picks up the closing costs on your behalf as part of the closing fees.
Number 9 is they don't know how to properly take care of a home.
Yeah, and that's I see that especially with the younger generation. They love the idea of owning a home, but they don't know much about the maintenance of homes. And that's where YouTube is our friend, because even if you don't have a family member that's skilled in helping you with the house, you can YouTube a lot of the things. And if you've got some basic hand tools, there's a lot of the stuff that like adjusting your toilet if the toilet's running or you got a leaky faucet, that kind of stuff. You can hit YouTube, and 5 minutes later you got your wrench out and you're fixing it. So it's a little easier today than it used to be, because you have access to that information that really wasn't available unless you were willing to go buy the handyman book and learn how to do it yourself.
And lastly, number 10 is they think that they're going to be in the house that they purchased for the next 30 years.
Yeah, and they're freaked out. They're like, oh my gosh, I can't make a commitment for my next 30 years. And the reality is there's so few people that buy a house that keep that house for 30 years. The average person, when they buy their first house, lives in that first house usually about 5 years on the first home. And then their circumstances change. Either they bought a small house that was affordable, and then maybe their family is growing, or maybe they bought it single and then now they've got a significant other or a spouse. Now they want more space, or maybe they have children. Maybe they have a family member that needs to move in with them for health reasons, so now they need a bigger house. So don't let the idea of you're locking yourself into a home for 30 years hold you back, because the odds are you're probably going to live in that house, especially your first house, somewhere between 5 and 10 years, and then you'll probably sell that house, take your profit or your gain out of that house, or your equity, take that money and apply it towards your next house, which helps put you in a better financial position for later years. Because you have to think about a house as a savings account, a long-term savings account for you. As you make your monthly payment, it's paying your mortgage down. And while your mortgage is going lower, in most cases, the house value over the years is going up in value. And that's where you're building equity, or you're building some retirement money, or building assets. So I'm Sam Miller, REMAX Stars Realty. Thanks for watching.
I'm Erica Miller. Thank you so much for watching.
And we'll come back to you again next week. Thank you.
Bye.
Bye.